a lot of people think just because their credit is perfect that they should qualify for whatever there is. When we're taking a look at what you qualify for, you're like, hey, I'm thinking about buying a house and I want to get pre-approved. We might ask, so how much home are you looking at purchasing? What price point
what
are
price
you,
range
what price range you're looking? Where do you want to see your payment? All of that good stuff. Typically the payment doesn't match the price.
That is very true.
I'd like to buy a $700,000 house and I'd like to spend $980 a month.
Right.
Unfortunately, not today.
It doesn't work that way.
Not today. So, but something that we take into consideration along with your credit score, but sometimes more importantly than your credit score, right, is called the debt to income ratio.
Which is one of the key factors in getting pre-approved.
It is. So sometimes we call it a DTI, right? So What is a debt to income ratio? DTI, that's the percentage that shows how much of your monthly income goes towards paying your debts.
Yes.
So give me an example.
So the calculation is your gross minimum monthly payments divided by your gross monthly income. Right. That's the formula.
And a lot of people think it's your take-home pay, but it's not.
Which is your net income. But we use gross income.
So we go ahead and we calculate that. But when you're purchasing a home, we throw in that mortgage payment too, right?
We do. We're looking at all of the debts that show up basically on your credit report.
Right. So that's going to be stuff like your car payment.
Yes.
Credit cards.
Yep.
Student loans?
Yes.
Any personal loans you might have taken out?
Yes.
Right? And then if you pay child support or alimony as well. And sometimes some of that stuff doesn't show up on your credit report.
And don't forget IRS tax liens.
Yes. So IRS payments, IRS tax liens, all of that kind of stuff. Anything that you owe, unless it's, something that hasn't been reported or recorded.
Right.
Because there are reports that lenders do after you're in the process.
Yes.
So maybe you do have a payment plan with the IRS and it's not showing up on your credit report. And we start the process and we get into it. Lenders do behind the scenes reports and those things will show up.
They will.
They will show up and they might show up later. So the best thing to do when you're sitting down and talking to a lender, when you're like, hey, I want to get pre-approved, we're going to ask you a bunch of questions. We're going to ask you, are there any, undisclosed liabilities? Do you have a payment plan with the IRS? Do you owe the IRS money?
And it makes things easier if we know everything up front.
Heck yeah.
So we can address it right away.
Heck yeah, because there's nothing worse than getting through a process, finding a home that you love, putting an offer, getting it accepted, and going through the process only to find out, what's this? This came up on this report.
And then we have to scramble and figure out how to make it work.
Yep. And so along with your debts, when we are pre-approving you to purchase, we also then include a mortgage payment.
We do.
And that's how we determine actually the number that you're approved for.
Yes, because they'll have what's called a front end ratio and a back end.
Right.
So the front end is just the debts like your installment loans and revolving credit.
The stuff that you owe now.
Right. And then the back includes the mortgage payment.
It's the stuff you owe plus the mortgage payment.
Yes.
So, for example, you make $6,000 a month in gross income.
Yes.
Let's just say you've got $2,400 in debt. So that's your car payment, some student loans, all that kind of stuff.
Right.
So when we take a look at that from a lender's perspective, how much is that?
That's about 40%.
That's about 40%.
And how do we come to that number? We take that monthly debt of $2,400 divided by that monthly income of $6,000.
Right. And so the DTI lets us know, how stretched your monthly budget is, right? And whether you can comfortably take on a mortgage payment.
Right.
So sometimes lowering the monthly debt payment could improve your buying power.
It could.
And so we take a look at it sometimes. Sometimes it makes sense. You're amazing at this. You're amazing at looking at someone's liabilities, their debts, and saying, hey, maybe, you've got this $2,000 credit card that, you owe $2,000 on. Your payment is high. It's $100, I don't know, whatever that is, $100 a month or whatever. That can make a difference sometimes, can't it?
Yeah, we look at all of the debts and figure out which one works best. Do we need to pay off 2? Do we need to pay off 3? And just to look at it and see how to make it work.
Right.